During a Keynesian-style recession, you always see commodities falling hard and gold also falling, but falling a lot less than other commodities. So even though gold and silver will be falling nominally during this final Keynesian recession, you will see this ratio climb higher and higher and higher as this happens. And then once they start printing the money again, nominally, it will slingshot to, I believe, $3,000, $4,000, $5,000. It could be by the end of this year or early next year. Whenever the next printing round starts, the climb is going to be extreme.
All sub-indices, including precious metals, have fallen over the past 5 years, but gold has risen. Gold has also outperformed major commodity sub-indices over the past 10 and 20 years, and most individual commodities, many of which have delivered negative returns in recent decades. Global financial analyst Rafi Farber emphasizes that gold is hitting a key resistance level and could rise faster than other commodities, especially during a Keynesian-style recession. According to him, commodities typically fall hard during a recession, while gold declines much less. Due to its reputation for being a safe haven asset, gold tends to perform well during a recession. For example, when the stock market collapsed in 2007, investment demand for gold spiked and continued to rise, and gold doubled in value between 2007 and 2011. From a technical perspective, Farber predicts gold could soar to around $5,000 by the end of this year when central banks resume money printing. He advises that this may be the final chance to acquire precious metals before their prices surge in what he calls the slingshot, marking the endgame. According to the Bank of America, gold has surpassed the euro to become the world's largest reserve asset, second only to the US dollar, representing 16% of the reserve pool. Based on macroeconomic factors, Farber underscores the 10-year minus 2-year yield curve normalization as a key indicator of an impending Keynesian-style recession, similar to past events in 1990, 2001, and 2008. Consequently, he believes that once the Fed starts cutting rates in response to liquidity problems, the 10-year minus 2-year and the 10-year minus 3-month spreads will rise rapidly. Benchmark 10-year Treasury yields fell to a 15-month low on Friday before paring back in choppy trading as August payrolls report failed to signal the size of an expected Federal Reserve interest rate cut later this month. Now we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Gold relative to other commodities is at a major resistance level here at, 9.41. The high on May 17th is 9.42. I'm discounting this because this was during the lockdowns, which gave it an unfair boost. But you can see here, this is the final resistance. And we could see gold climb a lot faster than commodities. Obviously, during a recession, during a Keynesian-style recession, you always see commodities falling hard and gold also falling, but falling a lot less than other commodities. So even though gold and silver will be falling nominally during this final Keynesian recession, you will see this ratio climb higher and higher and higher as this happens. And then once they start printing the money again, nominally, it will slingshot to, I believe, $3,000, $4,000, $5,000. It could be by the end of this year or early next year. Whenever the next printing round starts, the climb is going to be extreme. One final sign that the Keynesian-style recession, the final one, I believe, before the last round of printing, is on the way, is that the 10-year minus 2-year curve has normalized. It is now above zero. I think it's like 0.04 or something. That means that 10-year yields are finally above 2-year yields. And when that happens, this blue line over here, when it starts to go above zero, very shortly after you have, again, a Keynesian-style recession. I don't want to call it just a recession because it's just the revelation of the ills of monetary printing. So it's a Keynesian-style recession. We saw it in 1990, we saw it in 2001, we saw it in 2007, 2008, and we're going to see it again now. The question is, what is going on with the 10-year minus 3-month spread, the difference in yields between 10-year and 3 months? That is still below zero, meaning 3-month yields are still far above 10-year yields. And we see here a divergence in this rectangle here. And I put here, what the ... Why is there a divergence when this usually goes in tandem? Well, I zoomed in over here on 2001, and this might be a precedent for the 10-year minus 3-month rate spread diverging from the 10-year minus 2-year rate spread. It diverged very temporarily, ephemerally, even we saw the 10-year minus 3-month head down even further below zero to about -1, while the 10-year minus 2-year spread was above zero, but that quickly repaired itself and these started going in tandem very shortly after that. So I believe that if the 10-year minus 2-year spread is heading above zero very shortly, the 10-year minus 3-month spread will head above zero quickly, and it will skyrocket back up once the Fed starts cutting in response to a plumbing problem. For all those reasons, I believe we are months away from the final crunch. It's already being seen in the diamond market, in Dollar Tree, the opposite ends of retail. It's being seen in the labor market. It's being seen in Bitcoin. It's showing up in the yield spread, the 10-year minus 2-year yield spread. We're going to be there very shortly. And when we get there, I don't expect immediately gold and silver prices to go up. They will probably go down until the Fed money starts going into the monetary system. It's going to take a few weeks from when they print one last time, and that will probably be your last time to stack gold and silver seriously. Be ready for it emotionally, understand that it's probably going to happen, and then enjoy the slingshot higher, because I believe that slingshot.
During the interview, Rafi Farber explained that reverse repos have fallen below $300 billion. Farber notes that in 2024, $446 billion in net bill issuance led to $403 billion in reverse repo drainage. He predicts reverse repos will hit zero by October, signaling the start of a final Keynesian-style recession. Analysts said investors may have pulled their money from the reverse repo market and placed cash in the overnight repo market, where banks and financial firms such as hedge funds borrow short-term cash using treasuries or other debt securities as collateral. With challenging bond auctions and reverse repo balances dipping below $300 billion in early August, the U.S. Treasury will likely find it increasingly difficult to replicate its previous strategies to ease pressure in bond auctions in the future. However, Farber warned that with 66% of bank reserves used for repos, the ratio could reach a crisis point at 83%, similar to 2019. He predicts this disruption will occur in 3 to 4 months as reverse repos dry up, accelerating the timeline. Let's get back to the interview.
This is related to the reverse repos, which are down back below $300 billion yesterday to, I think, $291 billion. So here, what you can see is that I copied this from SIFMA. That's that organization that puts all of the crunches the numbers for all the treasuries that are issued in the previous month. So here we have August 2024. There were $206 billion. You can see that in the lower right-hand corner here, $206 billion of net bill issuance. Why is bill issuance crucial? Because net bill issuance is what sucks out money from the reverse repos, from that final spare dollar tank that was created in 2021. Money moves from there into bills. The bills are sold for dollars that go to the Treasury's account, which spends it on welfare and warfare mostly, and empties out the reverse repo tank. You can see that the net issuance for 2024 has been $446 billion. And if we go to the next slide, you can see that the net drainage of the reverse repos in 2024, remember, $446 billion, and the net drainage has been $403 billion so far for 2024. We started 2024 at $705 billion in the reverse repos. We are now at $291 billion in reverse repos. The difference is $403 billion, very similar to the net bill issuance. You can see that the bills, the dollars, come from the reverse repos, go into the Treasury's account. So this will empty out. The ground zero is now for the end of October, if this rate is replicated for the next 2 months, and I believe it will be. But if it's October, November, or even September, it doesn't really make much of a difference. We're still within months of the final Keynesian-style recession, depression, crash, whatever you want to call it. It's a slowdown or it's a catastrophe. It's going to be what it is. Now, once we run out of the reverse repos, what happens is this. In the blue, we have the amount of bank reserves in the banking system as a percentage of the amount of repos, of repurchase agreements that are made every night. The repos come from reserves. I've said this before, but I want to show you where we are on this chart. We're at 66% of all of the reserves in the banking system are used by repos. You can see here that the percentage of reserves used in repos goes up as the balance sheet, the Fed's balance sheet, which is in this red here, goes down. As the balance sheet goes down, the percentage of reserves used by repos goes up. And the last repocalypse was here at 83%. When 83% of all of bank reserves were used up by repos, that's when we had a clog in the plumbing. And that is when the balance sheet had to start moving up over here on September 17th, 2019. You can see this goes in inverse direction. And you can see here in this triangle, when we had the regional bank bailout over here, when the Fed's balance sheet blipped up again during that regional bank bailout, you could see that the proportion, the ratio went down slightly during that little jerk up in QE, but it is continued to rise as the balance sheet has continued to fall. At this rate of the increase in this ratio, we got to get to 83% for there to be a crisis, probably 83%, somewhere around there. We are going to hit that level in about 6 months, but after reverse repos finally do zero out, this ratio is going to rise even faster. So if you take maybe 2 or 3 months off of that total, we have about 3 to 4 months until we have what looks to be a coming repocalypse. And that will be after the Keynesian-style recession that is building up becomes absolutely obvious.
Gold continues to trade cautiously around $2,500, trying to break the cycle of negative September returns, a seasonal trend that has seen gold trade lower in all but one of the last 10 September. What steps are you taking to prepare for the potential economic fallout from these emerging financial trends, such as gold buying? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.